You are now relearning economics.
Welcome back to the Relearning Economics live stream. Hope you guys had a good week. Hopefully you had an even better weekend. Getting a little bit of this on, if you're old enough. That's always fun, isn't it? I want to talk about Joan Robinson today. Now, I put out tweets on my X account daily, multiple times a day. I schedule them all, and they're famous economist tweets, ones that I find intriguing, you could say. I should always disclaim, and don't put it in there, but it doesn't necessarily mean I endorse these famous quotes. I just think they elucidate mental responses when you read them. It makes you think. And I'm always an advocate that you shouldn't blindly follow what your authorities say in economics, although you can find good authorities and, put pieces together, put that puzzle together in your own mind, and then make up your own damn mind about things. And that's why I post these quotes, because I want people to think, I want people to be engaged. But as you know, X, formerly known as Twitter, can be quite divisive, to say the least. So I get about 1 million impressions a month on my X account. So obviously there's going to be some trolling going on in there, in the replies I get and whatnot. And sometimes there's some, good critiques about maybe some of the quotes I post. And then obviously there are extremely hurtful things that are said to me personally. But I've learned to ignore those and call it a sign of success. Because when I look at their account, not a whole lot's happening. So I want to kind of discuss that. And so in 1937, she said, that it's not savings that cause investment. It is investment that causes savings. And I'll paraphrase that. And we'll kind of look at, the body of work that happened this week leading up to a discussion about this on this live stream, which we kind of touched on Friday on the the Mr. Keynes and Dr. Keen, the economic live stream every Friday at 10 a.m. Pacific time, 1 p.m. New York time. That would be 6 London time. Make sure you check that out. Kind of discuss that there with Professor Mike Radzicki. And there's some nuance to it, and it led me to writing a blog. And very much what Robinson was saying was not the identity that we see where, S equals I or I equals S. You can just flip it back. But that's just an identity. She was speaking about the causal aspects, what is causing what, right? What is the structure of the economy to cause savings to equal to investment, or vice versa, or something else entirely. And I think I'll bring up my my X account first. I'm gonna start that way. Yeah, we'll start that way and take a look at things, see what's going on. Let's bring that up now. Share. There we go. We'll share that. How are we looking? Let's make this big. Taking things down. Let's say hello to the chat. Who's in the chat so far? We've got Douglas. Douglas, how you doing, buddy? Sunday. Did you have a good weekend? Things fun? Get a little bit of this going on. Oh, you can't see my face right now, but I was doing the beer drinking signal. Colin, greetings from New York. Glad you're kicking around. It's good to see you. So anyways, these are the, on the screen, you'll see these are the tweets, quotes, posts that I put out about twice a day, sometimes 3 times a day. Some attract thousands of likes. Some attract hundreds of hate comments. Some just are average. This one was a fairly average one. And the quote is, It is the rate of investment which governs the rate of savings and not vice versa. Okay? And so that's pretty intriguing itself. Obviously, the identity says they are both equal, but when you look a little deeper, savings, that's kind of an ex post, right? That's after, investment happens, right? So let's take a look at first comment here. Certainly not in a fiat currency system with a central bank controlling interest rates. Now, this is, I don't know, what would a psychologist call this? Deflection? It has nothing to do with the quote. I get a lot of that. So we'll skip that one. How about the next one? A guy named Ernest. In the real world, anyone who followed her advice suffered, and in brackets, Soviet Union, Latin America, Sub-Sahara Africa, India, Japan, the list goes on. Only in very rare cases does her proposition hold. Example, if there is idle capital, otherwise we have government inflation, classic boom bust. And this guy is a classic Austrian economic armchair commenter on X. So not a lot there. So one of the big controversies with Robinson, she did show support to North Korea when they were starting to develop, et cetera, et cetera. It didn't turn out well for North Korea, and later in her career, she admitted, it was very problematic. And one thing I think, even with the best thinkers, including Einstein, is they're prone to be wrong sometime, and that doesn't really negate all their other work, and hence this post doesn't really address anything. How about Owen Pine? Now, I think Owen Pine might be kind of libertarian. Consumption out of profits, interest above inflation. Oh, he's writing a poem, I think. Or economic rents are compatible with social waste. We'll skip that because we don't know what it actually means. Michael A. says the dilemma, which comes first, the hen or the egg? And when I summarize all this later, I think I'm going to nuance it between looking at a monetary perspective and a real perspective. Now, on the monetary side of things, it's very, very easy to show that investment is driving this whole cycle. It's a little more convoluted when you look at it from a real perspective, because academic economists like to call something savings when they're just businesses. And we'll get to that. Fabio E. Zola. I love these names. Other economic theories, and in brackets classical and Austrian, and real world scenarios show that savings can also govern investment, particularly in the long term in capital scarce in economies. The truth depends on the economic framework and conditions. And to this, I'll give a half agree. I like Fabio. I see him on my posts, and he's usually got something insightful to say. And he is right. And I'll sum it up. He says the economy is a dynamic system. And then we got Gabriel, and he says, blanket statement, savings come before investment. All right. You put your opinion out there, and I don't know if I go around with them. No, I don't really get involved here. Philip Armstrong came in and said, in a non-monetary economy, Gabriel says, explain, in the monetary economy, no savings are needed for investment. Where exactly are you getting the resources? So Philip says, in a monetary economy, when he speaks, he's saying in a non-monetary economy, savings have to come first, which I will nuance in a little while. And Gabriel says, well, explain how in a monetary economy, no savings are needed for investment. Where exactly are you getting the resources? Well, that's the non-monetary economy. This is where things get kind of convoluted in economics, right? Because we often use terms and talk by each other, and I think we can do better than that, right? So what else? I did this post. It was great. I put it up there, stirred up some emotions and hopefully some insights. And I say, you know what? I'm going to write a blog. Okay, I'm going to write a blog. So you can find the blog. See if I can bring that blog up here right now. So right here, it is paid right now on my Patreon, but I will be releasing it this coming week onto X, and actually making it free on my Patreon. So if everybody wants to read it, and so I go into detail on the monetary aspect of why she was right. And so when it comes out, or if you're a Patreon member already, and that's patreon.com/relearning economics, check it out. Because it's going to give you some insights. It's going to give you a detailed reason of why she said that. We flip back. Let's go back to Twitter X, because that's always fun. Share. So we go back. Oh, look at I'm live here, live on X, live on YouTube. Make sure you hit the subscribe button, hit that notification bell, like, comment, chat in the live stream portion of your interface. We'll go to a thread. So I decided I'm going to create a thread based on the blog I wrote, based on the quote I posted. So as you can see, you can kind of see where this train's going. I am getting deeper and deeper into this. And so I'll read out the posts, right? This is a thread. I think I did a series of 10 posts. Mainstream econ says households save, banks lend savings, firms invest. Robinson flipped it. Investment comes first, savings follow. Once you see how money and banking work, it's hard to unsee. And so I decided when I was writing the blog, I'll use a simple model, and I'll use a dynamic model, not one that goes into, some optimized equilibrium. Not going to do that. So the Goodwin growth cycle shows it. Investment drives output and jobs, which equals higher employment, boosts wages. Rising wages can squeeze profits, investment slows, and the cycle repeats. It starts with investment decisions, not household savings. So where does money for investment come from? And this goes back to Gabriel's, question to Philip. Not from a pool of prior savings. Modern banks create credit. When they lend, they create deposits. New money is instantly funding investment. Firms borrow, spend, raise output and incomes. Only after incomes rise does savings appear in the data. In national accounts, investment equals savings. But causally, that runs from investment to savings, not the other way. If households actually save more by spending less, firms sell less. Lower sales, lower profits, less investment. So without another source of demand, so that would be government deficits or exports, higher saving today can actually reduce investment. I went on to talk a bit about Steve. Of course, we can't forget the great Steve Keynes in these conversations. So Keynes extended the Goodwin model to include private debt. So firms invest if they're profitable, if a profitable demand is there. If profits aren't enough, they borrow. Banks create the credit that they need. And again, credit investment lead, savings follows. Right? So I kind of go on here about, some policy. So if households cut spending and no one else fills the gap, the cycle reverses. Investment slows, income stagnate, savings vanish, right? Can't have savings without investment. I know we'll get to the chicken and the egg postulate in a bit here. In a credit creating economy, investment is the engine. Savings are just the shadow it casts. I tried to be really profound there. I think it worked. I think. So, Robinson's line isn't just rhetoric. It's basic truth about how the monetary economy works. That's as simple as that. And of course, this thread garnered some attention, mostly from neoclassicals and Austrians. And one person did point out, and I'll get to him. I like him a lot. We're on different ends of the spectrum of the situation. Let's drop in and say hello to the chat. See what's going on here. Tony's in the house. Tony, how you doing, buddy? It is early in the morning. You are a dedicated man. Next Sunday, let's plan to have you on the show. Let's talk about energy. Let's do that. Tony's in the house. How you doing? Frank Perrott? Am I saying the last name right? Perrott. New York as well. Jeez. The Big Apple. The East Coast. Brooklyn, Queens, the Bronx, Manhattan, Staten Island. It's going to sound like a rap club or a rap song here soon, right? 50 Cent. How you guys doing? Good. Any questions or comments, put them in the chat as we kind of dig a little bit further into this. And who else do we have? Lars? You're rolling in. What time is it there, Lars? In Europe. What part of Europe you in? What country? Lars, see you on X. Pretty sure I see you on X. Pretty sure. See you a lot. Yeah. See you in the comments. I think we said something to each other yesterday. Get so many comments there, I lose track, to be honest. So I am sorry, but it's good to see you here. Colin's on Long Island. Did I miss Long Island? Did I not shout out Long Island? Oh no, wait, Long Island. Now Long Island is above Manhattan, right? That's where it kind of, correct me if I'm wrong. Get my American geography. Christopher from Hong Kong. Woo! We are international today. Crazy. Deer Point Macro. South Carolina. Deer Point Macro. Check him out on X. Lots of great data he posts. Lots of great graphs. Really intuitive. Like your work, Deer Point Macro. I think that's your handle at Deer Point. You just type that in the search, despite X's terrible search system, type in Deer Point Macro, find him, follow him. Good peeps. And we've got hi from, let's see if I can read this name. Let's see. HTHJSJNFBDJN. That's how I'm going to pronounce your name. If you ask any questions. Poncho. Patreon member. You're on my Patreon. Pretty sure. I think you are. We got so many Patreon members now. Thank you, everybody who's subscribed to the channel. That's always a beautiful thing. And you are from Austin, Texas. Stone Cold Steve Austin. What? Give me a beer. Right? Stone Cold. I don't know if you watched wrestling in the late 90s or not. That's what I think of when I think about Austin, Texas. Stone Cold Steve Austin. But let's carry on. I've gotten distracted here. So let's kind of carry on with my thought process. And we were looking at the responses to that thread I put out that elicited emotional responses. I'll make the chat small, make everything large here. There we go. And let's take out my name. Y'all know I'm Ty Keynes. So we'll take that down. Remember to do that. Like, subscribe, comment. So back to it on X. So Ernest, we saw him in the other quote post I put out. He simply puts nope. And so Carlitos, you'll see I comment and tag Carlitos underneath. Carlitos, when I first put this post out, actually here it is right here. He's like, can't wait to read some of the insane comments this thread will generate. Great stuff, Ty. Thanks, Carlitos. So I decided, we'll see what we get. And then he posted that like right when I put it out. And here's one. So I just put, this is a simple rejection without explanation. I get that a lot. People just hate thinking. And this is what it comes down to. It's not about, you can disagree with an idea. But when I see blanket statements like nope or something trolly, I realize at that point, this person must hate thinking. Like literally, they must hate thinking. Drives me nuts. Economics in one lesson in the 21st century. Now, I had him on almost 2 years ago, maybe. His name's Chris, giving away his government name, on the Mr. Keynes and Dr. Keynes live stream, formerly known as Steve Keynes and Friends. And he's a smart guy. He's got a good blog. You can just type in his screen name and you can find all that. I think it's on Substack. But we often disagree. But we agree on some things. And so what did he say here? I think part of the problem is seeing savings as an accumulation of money. If you see savings as an accumulation of capital, so that would be bricks, steel, vehicles, etc., or at least the means of producing them, it's obvious that savings comes first. And I'm going to address this when I sum everything up. And so I'll be summarizing it from a monetary perspective and a real perspective later. One thing I have problems with is making blanket definitions for dynamic systems, and i.e. the mainstream conventional economics and Austrians will say that savings is the capital stock, right? And of course I replied to him, we don't live in a corn model economy. And what I'm saying there is there's easy, ways to find special cases in economics where you can prove your point. And so if you want to prove the point in real terms that savings funds investment, you can say, well, listen, I'm a corn farmer and I plant all this corn. I pick it. I save some of it to eat, or I eat some of it. I consume it. And then I save a couple of these corn stalks and I replant them in the ground. I invest them because I save some, right? And that scenario, in a simplifying assumption, that can be correct, right? But we know, if we want to dig deeper in this conversation, we know in a modern economy, that is not the case. We are not all corn farmers, right? Or apple tree farmers, right? So we are not producing what we consume, and we are not saving what we invest. That is not how a complex dynamic economy works today, right? What else do we have here? Oh, right. So Elon Musk, he's a good guy. He's fun to follow on X. He posted, I guess Michael had commented on my quote, and we probably don't see eye to eye on a lot of things in economics. And maybe I'll snap to that because I did reply to him and he had a good sound reply. And I'll tell you, if you guys are watching me on X or, reading my posting, you want to engage with me, but you disagree, just articulate what you disagree with. Don't call me the R word. I'm working on getting monetized here. Don't call me the R word. Don't call me an F person. Don't say F you, right? Because that I am not going to engage with that. And I might just troll you back, right? Or put you on blast on my timeline, something like that, right? But some people do, and maybe we'll get to that one. So Dave Crossland, another Patreon member, was Joan Robinson truly the first to say this? And I replied, well, Keynes really put it forward first. Joan just carried the torch, right? So Joan Robbins, as I was talking with Mike Radzicki the other day on the other live stream, right? We were discussing that. And literally, Joan Robinson helped John Maynard Keynes write the general theory. So it came from Keynes, but Joan Robinson was there the whole time. Let's go through. Oh, this guy, Max. Now, this is conventional economics 101. I get these guys. So, no, and trust me, you don't want to start with a conversation with me like this. No, the textbooks say I and S are jointly determined in general equilibrium. And the textbooks are correct. I tell you, like if this guy has ever, read any of my other material, he would understand that that goes against everything I believe about a nonlinear dynamic system, right? They are not optimized to enter any general equilibrium. You can have a shock, and trust me, it will perturb it, attract or repel, and then a rebound. It will never enter into an optimized general equilibrium. That is a fiction of economic modelers using DSGE models. Absolute crap. Of course, I go on. I'm pretty sure that might be. Let's actually get right into the reply. Okay, this is where it carries on. And I tried to be fairly nice about it. I said, imagine an individual in the 21st century still thinks a nonlinear dynamic system such as the economy is optimized to a fictional equilibrium. So in DSGE models, there's very little structure to it. Often they'll have a placeholder stock. So it's not path dependent. DSG models are not path dependent, right? They don't work that way. You don't have a flow accumulating in the stocks. The system takes information from those levels of the stock and then starts creating endogenous behavior. These are all optimized equations to find a way to equilibrium. Then he goes on and says textbook models are nonlinear too. It's amusing if you look at the textbooks and what they call nonlinear, and then you go look at an engineer textbook and you look at what they call nonlinear, you're going to find a big difference. Okay. Of course, I reply to him, study nonlinear complex systems before you yap. It's embarrassing. And then it goes even further. He's digging his own grave. Yeah, that's what DSGE models are, my friend. Dynamic, stochastic, general equilibrium models. They are neither dynamic and they are not very general. I do like the stochastic part. I'm on board with that. There are things, chaotic events that we cannot explain. If we maybe knew all the variables in a system, right? And we could determine the initial conditions and the parameters, we could get chaotic behavior and we would understand it's a determined system. But in absence of that, and you're not modeling it, sure, apply some stochastics to it, right? I'm fine with that. But the rest is crap, right? So I go on. Dynamic stochastic general equilibrium models are a fictional construct of conventional economics. Often wrong and not very insightful. Go do some research on a man named Jay Forster and get back to me. Until then, keep playing with your difference equations and models suited for the 19th century. Now, I admit, I try to stay out of this, but I was turning into a dick at that point. And then, of course, Forrester, didn't his model predict mass starvation and overpopulation by 2020? No thanks. No, it did not. And no, he was not an author of The Limits to Growth. He did produce the World 2 model, which is the predecessor to the World 3 model, but he did not do that. And of course, I put that you're confusing Daniela Meadows, Dennis Meadows, and Jorgen Randers with the authors of The Limit to Growth. You are not very well read, are you? Now I'm just turning into a dick. And he says, so you know what I'm talking about. Now tell others that are still reading whose model they were using to make this is a widely mistaken prediction. Again, if you actually read The Limits to Growth, it does not claim to be a forecasting tool, right? It's just showing the path dependence of the system and where it could go. It didn't say, in 2020, the world's going to end, right? And some of its early runs, that was an area between 2020 and 2030. And what are we seeing with population right now and slowing down, right? So there's some validity to all that. And so I had to tell him, you do realize system dynamics, probably different terms, are used widely across engineering, physics, social sciences, epidemiology, biology, etc. And I admitted George Box once said all models are wrong, but some are insightful. DSGE models meet the criteria of that quote. So they are definitely wrong, and some are insightful. I conceded that to him, right? I keep telling you, economists use system dynamics. No, they don't. This guy does not use system dynamics, right? He's being fallacious. And in addition to ours, are also stochastic and satisfy basic consistency conditions, aka equilibrium. Imagine you're studying the human heart and it's in equilibrium. That person's dead. Come on, Max. And it goes on. I eventually gave him a paper to an updated version of the World 3 model where they just, they made some parameter changes, right? Changed some of the constants, right? But they were showing structurally the idea of the limits to growth model is well founded, right? From a global structure of the it's very basic in economics, right? But it has population dynamics, et cetera, et cetera. It's very well structured, right? It just needs to be updated, which it did. I left it with him, and then he pulls the stupidest crap I've seen. And I leave you where we started, a nonlinear dynamic system that jointly determines investment and savings. How about you study that for a bit before running around misinterpreting what academic economists think? Okay. Hell no. And what he did here is not very dynamic, not very nonlinear. And let me explain it here. So what he's put here in this equation in the middle, this is an ordinary differential equation, right? And it's saying, delta K capital is changing over delta time, and that equals investment minus depreciation. And so this part, pretty simple here, right? Delta times K, which is the capital stock, that's your depreciation, and that's fine. We can go with that simplifying assumption that you, as your whatever size your capital is, percent of that's going to depreciate. But up here, he literally just defines savings equals investment. There's nothing dynamic. He's imposing that on the system, and therefore saying, "Look, I'm right." Right? And this is a business. This is what really bothers me on the real part. Capital stock. It's not savings. So I ran a business, and I was in a trucking business, and I didn't go running around, to anybody I knew. I was in a business member club or other small businesses. We'd get together and exchange business cards, right, and try to promote each other. I never ran around when I said, "Oh, I bought this new truck. I'm doing a lot of good savings right now." Hell no. I was riding on the seat of my pants, right? And if you look at, a real term like that, so capital, what drives capital? What is the accumulator of capital? I. Investment. Right? I. Now down here he's just stating S equals I. And he calls it a dynamic system. Holy crap. I tell you, what's going on in chat? I'm going to address somebody I like next, though, because I think that's important. And it's going to kind of tie everything together. Let's bring up the chat, see what's going on here. Let's bring this down. What's going on? Tony Wilson, Deer Point Macro. One of the major problems in engineering are the deliberate underestimates to start a project and deliberate cost blowouts. It's all driven by econ and business majors, not engineers. Probably. You're an engineer, Tony, so you would know. I wouldn't put it past economists to lie. As you can kind of see there, just in a very basic topic about what Joan Robinson says, the shit that we see. Twitter beef. Yes, that's right. HTHJSJNFBDJN. That is correct. I love that name. It's perfect. Make sure you hit the like button, comment, subscribe. If you're over on X watching this live, come here because the chat's a little more entertaining here, I think. Let's see what we got here. From Frank. The corn came from the earth first before the farmer could get it. The currency and assets come from the government first. Then we can use and save it. The point. I think it goes on here. It starts, even corn farmers, the case, he needs to acquire the corn or the kernels first to plant in order to consume, and eventually plant excess savings. Yep. And don't get me wrong. There's nothing wrong with the identity of S equals I, because that's all it is. But what I'm trying to say, and what Joan Robinson and John Maynard Keynes were saying, is that's not causality. It's just an identity, and you can flip it either way, right? So when people do that to me, what does that mean? You're just giving me an identity. There's nothing dynamic about that. Don't do that. What else we got here? Well, let's go back. Let's go to the guy I want to address. I like this guy. He's Austrian, but I will say, and Dr. T, hello, how you doing, buddy? Glad you could drop in. Good to see you. This guy, his name's Aaron. He's really inquisitive. And we're much alike. We are both of us, him and I, even though he's on the Austrian side of things, and some people claim I'm on the post-Keynesian side of things. Some people even call me an MMTer. I don't like that. My name is Ty Keynes. I come from haircutism, post-haircutism. That's my new economic school. He's loves the game. He loves economics, right? So no matter where he stands, he's very engaged, right? And he has respect. Like me and him go back and forth. Super, super respectful. I have a great amount of respect. So before I post this, if you are on X, I don't want you to go dunk on him, because I consider him a friend on X, right? He's not a bad guy by any means. I'll bring this up. Shut the chat down. Make this big. Can I make it big? There we go. And we'll go check it out. I don't know if I retweeted it or not. I may have not done that, so I'll have to go in. Quotes. There we go. There we go. So Aaron says, happy to be corrected, but this seems to be a key semantic distinction between post-Keynesians / MMT and everyone else. Post-Keynesians, MMT guys, use the term savings to refer to nominal assets created by investment projects, while everyone else uses the term savings to refer to real resources not used for consumption. If you want to refute the other side, it is better to use the descriptions above in lieu of a polysemantic term savings. Otherwise, all criticisms refer to different topics. I think there's supposed to be an S there, than the one assumed. Now, he is correct. We do come from different perspectives, but I will tell you that if you go sit in an Econ 101 class and you actually start digging into savings and investment, they are talking in nominal terms. They are measuring. They might say it's constant dollars, therefore it's real, but they're talking about dollars, right? It won't go much past the corn model in like real physical. It won't go much past that. I guarantee you. Right. So I think it's time, to address a little bit of, my observations of both aspects, because I've thought about it. I think I should do a part 2 to the Robinson article I posted last week, because I think there needs to be more said about that. So we'll stop sharing this again. Bring up the chat. There we go. Here we go. Christopher, interesting question here. Do you prefer new Keynesians or neo-Keynesians? Well, there's you can, depending on the documentation you can look at, there is a difference, but they're essentially the same, right? It's a synthesis of neoclassicals and Keynesians, right? And ultimately, it's basically neo-Keynesians love micro foundations. They say you cannot build a macro model without micro foundations, which I completely reject myself, right? You can have micro foundations and you can build microeconomic models looking at a specific sector or an industry. I'm fine with that. But when you aggregate up to a very complex system like the national economy, for one, although we have AI now, you cannot assume there's one singular agent and they have all these rational expectations. And you're going to get real dynamics in your macro model. I always have advocated for, along with others, that you can define macro with macro, right? You can get your macro definitions from macro, right? And look at the system as a whole, right? And then look at its subcomponents and see how they interact. But that's another story. I get way off topic too easy here. But anyways, let's kind of sum this up. Let's sum it up from the monetary side first. So remember her quote, right? It is not savings that causes investment, but investment that causes savings. That's where we're starting from. That's where all of this starts from, right? So you have so we'll look at monetarily. You have the identity side of things versus causality, right? So investment ex post, right? Or savings, equals investment ex post. But this says nothing about what drives each other. It doesn't say anything, right? So that's very important, right? That's the crux of this quote, right? And if you go read in her 1936 book, right, it's all about causality, right? So like national accounting, like savings is simply defined as income not consumed, right? It's pretty simple. By construction, right? It can be either invested or wasted, but it's just an identity. It tells us about balance sheets, not about decisions. The real debate is about causation. Robinson argued that investment is independent. It's an independent variable. Firms make decisions, right, which create income. Part of that income becomes savings. So to say savings funds investment confuses the accounting record with the causal mechanism, right? That's the crux of this, right? Right? I'm not arguing the identity. Sure. Savings equals investment. Investment equals savings. Sure. I couldn't take that and model. I couldn't build a model with that. It's such a poor, bland simplification of things that I couldn't even take it as like logic and model with it. But I won't argue with the identity. What I am arguing, what Joan was arguing, is causation, right? And you look at it, and we're still kind of touching on the monetary side of things, right? Finance precedes savings, right? A great deal of investment is through finance, not waiting for prior savings. Now, I'm not saying that there are wealthy people out there that don't spend all their income and they'll go buy financial assets. They'll go participate in an initial stock offering by a firm, right? And that's like loanable funds, essentially. And now I know it's an equity stake, but essentially it's a transfer of money, right? And you'll get an income out of dividends or capital appreciation, right? Or bonds, right? Corporate bonds. But for a lot of fledgling small businesses and entrepreneurs, it's from themselves, right? Right? They put themselves in. And what they can't do beyond what they have, they go to a bank and they get a small bank loan. It's incredibly hard to do as a small business owner. I can tell you that banks will love to give you a second mortgage, not so much on giving you business loans, but primarily for small businesses and small businesses, bank loans, right? It'll cover your payroll, it'll cover like quarterly expenses, right? So it could be an overdraft, right? It doesn't come out of prior savings, right? It comes out of the decision of the entrepreneur, the small firm, and the bank considering somebody creditworthy. Okay, we can invest, right? But that isn't dependent on prior savings, right? So like in a modern monetary system, right? Banks create credit out of nothing. I know they settle between each other. Another debate, fractional reserve banking. We know that banks they can create the credit out of nothing, but obviously they're going to create it with some collateral in mind, right? We know that, right? A business that wants to build a factory goes to a bank. We're talking a small business. We won't get into large established corporations. The act of financing creates new deposits in the banking system, which shows up as income for someone else. And therefore, savings in the national accounts. It's a clear sequence: financing, investment, income, savings. Right? Right? Do it again. Financing, investment, income, savings. So this kind of demolishes the idea that savings must exist first and then be lent out, right? Unless you believe in the loanable funds model, right? How about another monetary paradox of thrift? Again, from a monetary perspective. So if households save more by cutting consumption, total savings may not rise. Think about this. Imagine households collectively cut their consumption to free up resources for investment. Demand falls, sales falls, firms cut back on production, lay off workers, total income shrinks. This paradox shows that savings doesn't drive investment. It's the other way around. Investment sets the level of income, which then determines the amount of savings that can exist, right? Again, I'm speaking from a monetary perspective. And whether there's a class out there, Econ 101, but we're talking about real assets here. Trust me, go up to a policy. If you are actually going to go work in the private sector, which half of these freaking academic economists that I battled out with, they haven't stepped out of the university hallway to go into the private sector and apply any of this learning they got, right? I don't do that. I do. So when you go out into the real world, and let's say you're working with a policymaker, they're not thinking about chicken eggs and corn stalks, right? They're thinking about money balances. It's very important why we were talking about this. So how about effective demand expectations, right? Firms invest based on profit expectations, not because of savings. No firm is waiting for savings balances to build up. Doesn't happen, right? Profit expectations is what drives, right? When I ran a small business, right, I saw an opportunity for profit in a certain segment of the trucking industry, and I decided to invest, right? A decision of investment came. I wasn't thinking savings. Now, when you go down to the individual, and this is where micro foundations, it's like, well, it's pretty simple. You know, a person wants to do something. They've got to have a little bit of this and put it into this. We live in a big, complex monetary system, right? We don't live in these little like igloos, silos of individuals, right? Making rational choices. Right? It's not how it works, right? It's a fun little exercise to say that, but it isn't gonna take you anywhere economically, right? So expectations, really what drives in the macro economy firms to invest is profits, right? If they are making profits, and we'll go to Minsky, right? So you can go up, imagine there's a function. Well, imagine a mathematical function, right? Which way would I be on screen here? Be this way. So let's say it's an exponential. And let's say you've developed some sort of profit ratio. Maybe it's, profits divided by your nominal capital stock. Let's say, and that's your profit ratio, right? And if your profits are low, then you're down here before you go up the curve, right? So you got a low investment multiplier because profit ratio low. As profits go up, you invest more. Eventually, you want to invest more than your actual previous profits, but you're in that euphoric stage. So you go get a loan. Now, a big corporation, maybe they do a stock split. Maybe they go public, right? Maybe release a bunch of shares, right? Maybe they do bonds. And so there can be that intermediation of money, but we're talking about where it all starts. It's firms. So you go to the bank. You say, I've got this. Look at my profits. They're growing. Things are going great. Like the fun ride never funds. It's kind of the euphoric Minsky stage. The bank sees it. You're right. You're making more and more profits. Fund's never going to stop. Loans officers aren't perfect either at banks. They're smart. Right? They will limit what they're going to give you, especially small firms. Versus a second mortgage on a house and getting an overdraft on your business bank account, it's easier for the second mortgage. So they say, okay. And now you're investing more and more. And then we can get in the business cycle. And then if the cost of credit rises, and of course it causes a business cycle, that's another story, right? So that's the example of the monetary aspects of things, right? And that's pretty self-explanatory. And I don't even think there's much debate around that. But that's where I was coming from. That's where Joan was coming from, right? That's where a politician would come from. That's where a policymaker outside of economics would come from, right? So if you have a so-called academic economist go to a policymaker or a politician and say, well, the savings balances are really low right now, we can't invest. Look at the policy decisions that come out of that, right? So that's why, the heterodox challenges terms, statements, identities, right? That's one of the reasons. We're not just going to talk about the monetary aspect of things here. We're going to talk about the real side of things. But first, as always, what should you do? You should. Well, going backwards. Like, subscribe, comment. I like that. I look at I made it different colors. So I was looking at the demographics. Take a little break from my lecture. I was looking at demographics. We don't have enough women interested in economics. Now, it's not just my channel, right? I do my hair, so I look good. But it's not just that, it's in general, right? So I made sure I made a pink like. You hit that pink button, right? And then subscribe. It actually kind of matches my relearning economics logo. So I was trying to be artsy about it. You can find me at Relearning Econ on X, where all this stuff happens, right? You can find me on Patreon, patreon.com/relearning economics. You find out all the work I'm doing with modern macro technologies, applied MMT at, yeah, you can just find that at relearningeconomics.com. It kind of just gives you a page of all the things I'm doing right now. Make sure you check that out. Be a whole lot of fun. But yeah, hit that like button. I'm trying to build this channel up. I also put on a post, what's the best time for me to do a live stream now? It's very hard to cover Australia and New Zealand, for instance, because then I'll lose Europe, right? The time I'm doing it now on a Sunday works. So I'm getting North America and I'm getting Europe. But come Monday, when I do my React show, check me out not Monday, Tuesdays at 10 a.m. Pacific, 1 p.m. Eastern. It's hard for people in North America because they're working, right? So I've thought about moving that down to like the afternoon in North America, but then I'd lose Europe. But then I could capture early morning Australia and New Zealand, right? So I think about these things. I'd love to capture everybody in the world that's willing to listen to me. It's hard with a live stream to plan that out. And people are going to watch these afterwards, right? It's just like a YouTube video. Great thing about live streaming, I don't got to sit and edit this crap later. Like that takes so much time, the editing process on YouTube channels. And trust me, I've done it, tried it. And so I was speaking to a consultant, about, what is the direction of the Relearning Econ channel, right? And decided it's live streams. That's the way we're going to go. I think it makes sense, right? Anyways, let's go to kind of some of the real aspects of things, right? So the real side. So conventional economists say, well, the capital stock and the fixed capital stock is like plants, factories, machinery, etc., etc. That's savings, right? That's now I told you at the beginning of the show, it's not really savings, right? And even if it is, where does that stock accumulate from, right? So you've got K, remember, we did capital, right? And then you have an outflow and an inflow. Your inflow is investment. Your outflow is depreciation, real depreciation. So dk over dt equals I minus delta k, right? Investment, I, drives savings. It accumulates into savings, a physical thing you are investing. So out of the financial part that we talked about before, right? Profits driving investment. Nominal investment, yes. But what's underneath nominal? It's taking real resources, right, out of the ground. So that's where, a lot of capital resources come from, out of the ground, and to build capital plans, etc. Another aspect of it is inventory. Inventory is not somebody's savings. It's something a market participant has not sold yet, right? And its production came from investment into a capital stock that produced output, right? It comes from investment. Again, we're not denying the savings investment identity. That is not the topic of what Joan Robinson was proposing in that quote, right? Investment accumulates into capital. With some sort of capital output ratio, output is created. Some sort of productivity level, depending on that output, you need so many workers, right? Starts with investment. Okay, workers. Now you got to understand, like when you build, like in my national model, we aren't just looking at it at a monetary level or just a real level. It's an interaction of both. We're dealing with real goods in the economy and monetary numbers and how they interact, right? So causality, the dimensions of causality can change to that loop. So let's say we're starting with investment, real goods, like goods. Let's define goods as something like a collection of goods, and accumulates into K, which is capital, your factories and stuff. So now it's, goods per year going into the stock of capital. Now it's just goods. All right. And then we can say with the capital output ratio, which we'll dimension in time, we'll say, because you've got, let's say, 300 capital units, real goods, you got a capital output ratio, let's say 3. That year, you're going to produce 100 units of capital, right? And then you've got, I'm not trying to get too mathy here, but then you've got your productivity level. And it can be dynamic as well. It could be influenced by profits or investment. But let's just say it's growing over time. And that would be dimension in goods per worker per year. So if you take output, which is goods per year, divided by goods per worker per year, you get workers, the amount of labor you do. It's dimensionally consistent, trust me, because I've done it a million times, right? And then you take, let's say, a population base. So if you look at the Fred data, the civilian labor force, right? You take that, and it's in workers too. So now you take the amount of labor demanded by the civilian labor force available for work, both dimensioned by workers, you get an employment ratio. That ratio is dimensionless. Now you can feed that into a behavioral function of, wage changes, right? And then you can create a new stock. And this is where I say in the chain of causality, you could be dealing with different loops, or different dimensions, different units as you go through that loop, but still be in the same causality. This is where conventional economics, they do not do that. You will not find a hybrid real and not a monetary model. It's not going to happen. And so you've got your wage change, and it's okay, well, let's have another system state. We'll call it the wage level. And you're going to define that wage level is dollars per year, right? So it's very hard to exclude, like, oh, well, we're looking at from the corn model perspective, right? No, you've got to kind of integrate both. You've got to look at it nominally, and you've got to look at the real, right? And you have to have some sort of dynamics where they're interacting together. You have to do that. If you want a feasible model, like a feasible macroeconomic model, you have to address that. Conventional economics does not do that. I challenge anybody to send it on my Twitter. Prove me wrong. Put it in the comments. Put up a post to a paper where they achieve that. Find one. Challenge you. There's other parts too, right? So there's the kind of like the growth scenario. Okay, so in real perspectives, right? So suppose consumption rises by 10%. Okay. Output raises by 20%. The extra 10% freed up by thrift consumption, it actually grew. Additional production exists because firms invested in capacity. Investment expands output. Then some of that additional income is labeled as savings. That was Robinson's point, right? That was her whole point. It's not hard to conceptually imagine that. It's not a rebuttal against an identity. She's listing off a causal part of the system, right? A feedback loop, you could say. That's what she was trying to say, right? Savings. I hate the word savings in a lot of ways, because savings is just what you haven't spent yet, right? So you'll read articles and stuff, and it's like the rate of savings is sure change. The rate of savings, if you really look at like a system as like a dynamic system, right? So in DSGE models, you have what's called the Euler's equation, okay? And it's I don't think it's the same Euler that does like for solving math problems. It's not like a first order solver in a dynamics. I think it's a different Euler that they named off this, and it's their function for consumption in a DSGE model. And it's very optimized to go into an equilibrium. So in our national model, and it is sophisticated because it is a large model, but essentially we're looking at the balances of households, and we're saying dynamically, but let's for illustration say there's a time constant, right? And we're saying households will run out of money after 3 weeks or 3 months, depending on their income class, right? And therefore income, so consumption, is defined by their bank balances, which is true in that sense, which is true. And they're not spending all their money at once. Time constant is saying they're not spending all their money at once. So what they have left over is savings. But that's just because they haven't spent it yet. So I don't even like the savings rate. I don't find it insightful. I don't find it useful. I find it as a residue of what you haven't consumed yet. Truthfully. That's my opinion. So holding off. Here's another example in the real, holding off on your consumption. So somehow this is where the convolution part really starts, when you don't actually analyze a nominal system, a monetary system, and a real system. People start thinking, okay, I'm going to look at this in real perspective. We're going to claim that, factories are savings, even though I told you early in the show, when I bought a new truck in my trucking company, that wasn't the savings for me, right? That was an investment. When you look at it only in real terms, then you're getting to the point, well, oh, wait, I didn't get paid in corn or trucks and cars or whatever factory I worked at. I get paid nominally, right? So causality, you have to kind of switch between the two. So we'll look at it like there's the abstinence myth, right? So history shows investment booms weren't caused by prior thrift. If you look at it, right? If you look at like major waves of industrial growth, weren't preceded by societies saving more. Okay, just look at the history books. Like railways in the 19th century were funded by credit and speculation, not prior savings. It's not even remotely close, right? World War II, mobilization, right? What else? What else could we think of? China's rise, right? Because a bunch of savings balances, right? Where they stocked up on things, stocked up on a bunch of corn and planted more corn, and suddenly you got modern China. So there's that aspect of things, and that's from the real perspective, right? These are the things Joan was trying to talk about. She wasn't talking about the savings identity. I'm going to say that over and over through this live stream, just to put that to bed, right? It is okay to read Joan Robinson and be like, wow, that is contrary to everything I was taught. I don't like it. I don't hear it, but I'm going to explore it. I'm going to go deeper, right? Because those are the areas, your blind spots. So you've got, I'm going to relate it to myself. A couple years ago when I was building out the national model, I had blinders on. Boop, 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 boop. I had lots of them, right? The way I got through those blinders was thinking outside of the box, right? Looking at other ideas. Maybe they were just logical ideas. So maybe, it was a deductive process in theory, which can be dangerous and helpful at the same time. It was outside of my comfort zone. I didn't like it. Didn't feel good because I had to admit I didn't know something. And it sucks. Okay. But once I pushed through that, I solved the problem and moved on. Saw the dynamics I needed to see. It's life. There are things I don't know. And then there are things I do know after I investigate them and I remove the blinders. I remove that comfy space that I'm in. I was taught something at age 21 and, Econ 101. It's okay to admit you don't know things. This exercise here, because I was in this, like when you read my blog, if you're a paid member or not, or you get it next week when it's free, you will see, I described that process of when I first saw that quote from Joan. I was like, what? This has got to be crap. This is crap. But I've always had an inquisitive mind, right? So I had to dig a little bit further, right? And challenge, the preconceptions I have, right? Savings, saying savings funds investment. It's really like the old saying, like the cart pulls the horse kind of thing. It really is from a causal perspective, right? I've kind of laid out a ton of things so far today, right? Savings is like really an accounting category, right? It's a number written down after the fact, right, of investment. Investment is a behavioral decision, right? More often than not, had absolutely nothing to do with whatever was saved in a physical sense or whatever was saved in a monetary sense. You can go through all the big technological processes, new firms coming up, right? Often had nothing to do with savings. That's just the reality. What's going on in chat? I haven't read the chat. I've been yapping for so long. I got a good video this Tuesday about the US debt. $37 trillion in debt. So I'll be 1:00 New York time on Tuesday. Check it out. If you miss them, they're all recorded. You see my YouTube channel. Stop sharing. I'm going to stop sharing. Turn that off. Got things running here. You can watch them after, right? But it's going to be fun. I'm going to enjoy doing that one. I like doing the React videos. They're kind of fun. And apparently it's the thing to do on YouTube. So I'm going to do that. Let's check out the chat, though. Kind of missed the chat while I was yapping. Oh. Well, there's Tony. See a lot of Tony. Okay. So I'm just getting into something here. So I'll have to go back and follow it. But yeah, logical machine. Are you guys agreeing with me? Because you guys seem to be affirming my point. Now I got to find out, what is this point, logical? I got to scroll through the chat here. Okay, here's his comment before. China is a great example of saving coming before investment. I just said that's actually a terrible example, right? Just because so Chinese are thrift, it had nothing to do with investment. You're conflating the two there, right? That's a cultural thing about consumption, right? It's not a cultural thing about investment. I really disagree with you there. I use that example. Woo! Where else? What do we got? Owen! Owen, you know what? Owen, pretty sure you're always on the Steve Keen channel. I think you were. I think I saw you there. It's good to see you here. Tony. Come on, Ty. Explain the Norwegian Sovereign Wealth Fund. Isn't that the second biggest wealth fund on the planet? What else? Okay. Oh, we got Tony fighting with me. Okay, Ty. If savings are bad, then explain. Okay. I never said savings are bad, right? I said in aggregate, if everybody saved, nobody would purchase anything and firms wouldn't have profits. That's what I said. Got nothing wrong with a sovereign wealth fund. Don't think it's necessary because sovereign nation, although the Eurozone has got some problems with that. Yes, they've decided to go to a single currency, but a sovereign nation doesn't need a sovereign fund, just like the US and Trump is. What was a sovereign fund going to be? It's like, why do you need a sovereign fund? You're a sovereign currency issuer. It's stupid as fuck. What else we got here? I'm dumb in macro. Nah, you're probably smarter than those conventional economists I talked to that spent 8 years doing a PhD. And didn't you get your doctor, Dr. T? You're probably smarter than them. Graham. Good to see Graham here. I just got to acknowledge everybody. Appreciate you guys tuning in, right? Whether you agree with anything I say or disagree, I agree. I like the conversation, right? It's very important, right? To have those conversations. Try to be nice about it, whether you're in the chat battling each other or whatnot. The dialogue's good. Good evening, everyone. If savings are a personal investment to be able to consume in the future, what happens if the future investment is spent on health services, which should never create profits? Well, remember when about 10 minutes ago, I said, that causal loop is both monetary and real. So people's health goes up, you live longer, you can work longer, you can produce more, etc., right? So there's that. I really want to stress to everybody that you should look at this not from an either or perspective of just monetary aspects or just real aspects. Got to causally infer it that they're both part. You're going to see dollar units and you're going to see physical units. It could be kilograms of steel, right? Bundles of firewood. If you're living up in northern latitude and you're chopping down trees like a Canadian logger, bundles of wood, gourds of wood, as you would call it. Anyways, what else we got here? I miss so much. What else we got? Going up. I wonder if I can make this chat so it shows more chats. Yeah, I don't know. I'd like to make that chat so it's a little bit smaller, so more chats actually fit in it. I banned micro years ago after talking to a math psych and academic marketeers. Yeah, I put this on my Patreon about a year ago. And I built using system dynamics. I'm a dork with that stuff. I built a macro model, and micro's not my big interest. My interest is policy in a macro economy. But I built one, and it was a farm model. Let's bring that up. Let's bring up this micro model. Let me pull it up here. Give me a second. And I'll go through a million folders here. Done models. And do I have it in here? Oh, geez. I know I have it somewhere. It's a cool little model. Supply chain model. Let's bring it up. Take a second to load. Still loading. There we go. And we'll share screen. Come back and we'll take this down, pull the chat down. We will share screen, window. And we'll make this big. So I built, now this is just a little toy model. And I think I was kind of doing something with an outfit called, that's similar to my handle, Relearning Economics. I don't know what, some big organization. It's basically supporting heterodox students, right? And we were, talking about, marginal costs rising or falling, right? And I decided, well, let's just build a dynamic model, of a system. And this one is like a pig farm, a cow farm, right? And you could look endogenously, would costs fall over time. That was, with some behavioral functions put into the model. So I built a model. You could run it endogenously, or you could run it yourself. And essentially, you had a farm and you had livestock, and the cost of holding these livestock is a cost, right? It's not until you sell them that you would make money. And if you had too much livestock, you'd have to rent another ranch to store your livestock, and that would be a cost, right? And so I built that model. You could run it either way. You can run it endogenous, so I'll just let it run. It's been a long time since I opened this model. This model's running endogenously right now. Right? I don't know if that's showing up on screen. I'll remove that. You can see over time expenses fall just by building the function, right? And it's an age and chain model, basically. So, cows are born, they mature, then they can be breeding cows or they can be slaughter cows, right? Is run the model over time, and it was just the basic assumptions of a firm, right? Even like the classical assumptions of a firm, the conventional economics way of a firm. But I decided to model it dynamically because I wanted to see what would happen to costs over time, and they fell. Right, so this is the type of microeconomics that it should be done, right? And of course, you can run these simulations yourself, and you could parameterize this to be a real farm somewhere and run dynamics there, right? So you can run your model, and now you can make, decisions about, let's speed it up a little bit, about, if you should sell. So now my costs are rising. I do have a random number generator in this for sales, right? And I'm over capacity, so I've already crashed the model. I screwed that up. I screwed that right up. Let's try that again. Slow it down. We don't want this black line over here to go over capacity. So we're just going to sell. Okay. So now we're making money, right? But we need to breed our livestock, so we can't just sell off the farm, right? And this is kind of like the beer game. I posted something about this quite a few weeks ago, right? About delays in a system and the bullwhip effect, right? And these, as a human, if you're a policymaker, you're making decisions based on the system you're seeing. You're overreacting, underreacting, and you'll never find equilibrium. If you do, your system's your company's out of service, it's bankrupt. Or if you're a doctor and your patient's in equilibrium, his heart has stopped, there's no brain function, and he's dead. Right? So that's the kind of economics, microeconomics I want to see. It's just not my thing, right? So I do dynamic models of, the macro economy. Logical. What is logical doing here? Oh, and what did he say? Logical machine, how are you affirming your point? Credit creates investments assets, not savings. Anytime savings is spent to buy an investment, it's a swap of assets. Nothing is created. Correct. That's it. Logical, you lost. The group has spoken. Who was from Austin, Texas again? What? Stone Cold. What? What? Who was from Austin again? Is he still there? Is the guy from Austin, Texas still here? I'm not talking about resources. I'm talking about resources, not money. Comes out of the ground, man. Right? Nobody's saving anything that's in the ground. Right? When a company runs a business, capital stock, it's a business. It's not savings. Their inventory is stuff they haven't sold yet. It's not savings. They're not planning on saving it for a rainy day. They create it output that's meant to be consumed. Right? Consumption goods, real consumption goods, are created by capital goods. Right? It's fallacious. Once you go beyond the identity of S equals I, everything else in conventional economics is fallacious. Just explained it for an hour and a half. For your information, Ty, what we did was understanding demand surfaces in n-dimensional space via realistic but artificial scenarios. McFadden won a Nobel by doing this. I don't know who McFadden is. Was he an economist? Like, is this a Nobel Prize for economics? Because that's from a central bank. It's not a real Nobel Prize. But do you got any papers, or maybe put that in the comments? Or shoot me a message on Twitter or something. I don't know what you're talking about. I don't know everything. And that's okay. What else we got in the chat? I do not want to hijack this. I'm here to learn macro from you, Ty. That's okay. Hijack away. I like learning myself. I'm open to ideas. That's how I've learned like so much. Right? I got no problem with that. Unless people just start saying stupid shit, then, well, my brain sometimes turns off. Just going through the chat here, seeing if anything's interesting. I really want to talk to that guy from Austin. Austin, what? Stone Cold Steve Austin used to do that. He would say, what? Every time you ask something, what? It was really, really quite irritating for the other wrestlers. Oh, here we go. So McFadden won a Nobel by going under the radar. The Swedish central bank didn't realize he was subversive. Oh, subversive. He was indeed. Okay, well, I'll check him out. Sounds interesting. Tony, what's Tony saying? Logical machine. One of the major problems is people not understanding the concept of natural resources. Tony, next week, you're going to come on this show, the Relearning Econ show. We're going to talk about natural resources. Okay, buddy? That's what we're going to do. I'll send you an email. I'll let you go. Steve won't be here. Mike won't be here. Dan won't be here. Dave won't be here. But I'll be here. I'll be here. Me and you can do this together. Where do natural resources come from? What do they do? Do you convert natural resources from one energy state to another energy state that's a little bit less useful or a little more useful? Bum, bum, bum. I need my little soundboard I used to have so I could do sound effects. Monday. It would be your Monday. So like today, a week from today, this time. I'll send you an email. I'll send you an email later today, my time, which will be like afternoon your time. You'll get an email from me. Make sure you reply back to it so I know you got it. I'm assuming your email hasn't changed. So a week from today, this time, we'll do it. It'll be fun. It'll be lots of fun. So I think that's something we need to discuss because it kind of ties in. It kind of be a part 2 to this, right? If we're going to really talk about physical resources, we might as well start talking about productivity and energy conversion, right? And that's right up your alley, Tony. So that's where I could really utilize your expertise on this topic. Logical machine. What do we got here? If people are using their labor to create consumer products, they need to stop making them, saving to move on to making capital investment. Some companies produce consumption goods. Some companies produce capital goods. All goods have to be produced by capital goods, right? No one workers decide, oh, Jesus, I need to start saving my labor and create capital goods. So not how it works. And all those consumption goods, they're created by capital goods. There's no decision, either or decision. They all have to be created by capital goods, right? It's the act of investment, the desire to invest, the demand for capital goods that starts it off, right? You don't need savings, doesn't matter. None of that matters. It's the act of that initial investment. It's where it starts. Anything else is fallacious. It's just fallacious thinking, a simplification, another economic simplification. What do you mean? This is the perspective, the macro perspective, not the perspective of the worker. There's no macro perspective, right? Capital goods produce consumption goods. Capital goods produce capital goods, right? Once you're at the point of consuming consumption goods, there's no saving of your time. It's already done dynamically and temporally through time. It's simple as that. Investment comes first, no matter if it's real or it's nominal. It's that simple. It's not hard to figure out. I'm not disagreeing with the identity, right? But they match up ex post, like after the fact. Frank? What does Frank got to say? People invested their labor, then consume less than they produced, which creates the savings. People invested their labor, okay, then they consumed less than they produce, which created their savings. Well, created profits. Like I agree with your train of thought there. But we could nuance it a little bit more where we're thinking about both the real economy and the nominal economy. So people have gone to work and they get paid. As Marx would say, I don't like using this because it's very ideology, a subsistence wage, right? And capitalists take a profit. So they go away with a certain amount of money and they can use that and buy what they made, right? Ultimately down the line. I wish maybe even next week I'll pull out. I don't want to make people's eyes glaze over, but maybe we could have demonstrated this with a Goodwin growth cycle model. That would have been a good idea to do that, because the Goodwin growth cycle can be converted both into a real only model, a nominal model, or a combination of both. It gets a little complicated, and I don't want to make people's eyes gloss over. Then nobody be watching, and that'd be kind of boring. Bud's in the house. Let's see what Bud's got to say. Does this mean Say's law is false? Yes. Yes. Go check out my Twitter account. Say's law is another identity, right? So, like, if I take it dynamically, it's not going to work. It's not going to work in a dynamic, structured system of behaviors. Does demand create a supply? Does supply create demand? Right? Just saying it as an identity, you can flip it either way. And this is a conversation about causality, right? That's what's important to me. And, maybe even Tony and I won't agree on things, but one thing we will agree on is the causality. We need to know the causality of the system, right? We need to look at it going through time. And we need to look at the processes changing through time. We need to look at the lags, right? We got to understand the structure of the system, not just identities that are basically slogans in economics. And that's important. What's Tony got to say? Hey, Ty. Very simple. Anyone who earns anything from their labor is effectively earning profit. The question is really about if it's profitable enough to meet their basic needs. Well, if they don't, here's the thing: there is a counterbalance in a dynamic system. If we look at a very simple Goodwin growth cycle model, which is simply a predator prey model. And so if it doesn't meet their needs, they're not really spending enough for firms to make a profits, right? So firms are making less profits. They lay off people and their costs go down. But then because the costs go down, then they start employing people again, and you just create a dynamic loop. So I don't know, like, I understand what you're saying. I understand that if we look at when we start adding other sectors into the economy, so for instance, the financial sector, here's a good one for you. I don't know if you agree with me or not, Tony, but we've seen the rise of the financial sector since the 1970s, right? So, and if we look at the share of income, it's risen over time in that financial sector. Well, at the same time, the share of income in households has declined over time, right? So I've got problems there, right? I've got problems structurally of the capitalist system. So yeah, I agree with you, but there's a lot of nuance dynamically, how we, Zaza, okay. Number one, Zaza, Zaza, Zaze, Zaza. Sorry, I'm gonna do it every time. Do you know who Stone Cold was? Zaza? Stone Cold Steve Austin from wrestling from like 25 years ago. From Austin, Texas. You always go, what? What? I've been on that trip today because you weren't here, right? I wasn't able to say Zaza, 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 Zaze. I wasn't able to kind of go through all of that. I had to go, what? 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 The whole time. It's good to see you here. Oh, okay. Now, Bud, I know you're an Austrian. If we're on that island, we're talking about coconuts. We might as well just talk about the farmer that grows corn, consumes some of it, plants the rest, and calls that savings, right? So we can break economics down into simple parables, right? And then infer logic from that and say, well, that's how the economy works. Very dangerous road to go down. But I'll leave you to it. I won't argue with it because I know I can't change people's minds. Zaza. Unfortunately, no, haha. I'm going to lose it. You should check out Stone Cold Steve Austin. Just YouTube. I'm not going to be live streaming too much longer. Just YouTube Stone Cold Steve Austin. What? It's he came up with it, and so we know wrestling script. I don't watch wrestling anymore. That was back when I was younger, a kid. But it was The Rock and Stone Cold, and it was all as a kid. It was very very neat. And so he started doing this what routine. And backstage, if you watch behind the like other wrestlers were really they couldn't do promos with him because the fans would all be like, what? What? Like all at the same time. Like Stone Cold would say something, they'll all 20,000 fans would be like, what? Anyways, I've been doing that today. Trying to drive people away, maybe. I got a problem. I got to see a therapist about that, driving people away all the time. Uh-oh, Tony's going to start talking about Crusoe and the island. Could be interesting. Frank, what do you got to say here, Frank? Catching up on the chat here. Laborers don't earn an income until after the capitalist makes an investment. That's where the income comes from. The laborers come from the capital investment. Correct. Dynamically, that's correct. Right. Anything else is semantics. It's corn model economics if you reduce it to the argument from the other side. So it's fair to say that, yes, that S equals I equals S. You go either way as an identity, but one comes after the other. So from causality, that's what we're talking about in today's stream. Dr. T. Dr. T, I did a huge COVID model. That's how I first met Steve Keynes about 4 years ago. I did it for the province of British Columbia in Canada. I just see COVID in your name. Shouldn't say COVID. Maybe I'll get deranked on the video. Shouldn't say COVID. Hey, Ty, just be reassured that anybody let me know. I'm not hip like anymore. What does YNSW mean? Oldies. You may have influenced Steve, who wanted to marry your models to mine. Okay. That sounds deep. I am a little bit confused here. Are we talking about marriage here, or are we talking about mathematical modeling? I'm just kidding. What does UNSW mean? I'm just curious so I can answer that. What's wrong with the corn model? Well, if you're a corn farmer, nothing. If you're like from the 1900s and you're a corn farmer and your family, all it eats is corn, and you just got to save some of that corn to replant for the next year, there's nothing wrong with it. But that's not the modern macro economy. Just not. So it's a simplified assumption that doesn't really apply to anything. We can't take that logic and apply it to a complex dynamic system and say, oh, this will explain everything. You look at, you can plant bread and build a factory. That's just silly stuff, right? I don't get into that. It's parables, right? Stuff from the Bible. I get canceled for saying that. Maybe I shouldn't say that. I love the Bible. Oh, University of New South Wales. You're from Australia, right? That's right. I think you said that before. Oh, Tony's in there. Oh, geez. It's funny, I was writing the post the other day, community post yesterday. I'm worried I won't get New Zealand or Australia, and there's two of them in here. Dr. T, are you in Australia now, or are you in North America? Kind of curious. Because if you're in Australia, you're just as bad as Tony. You guys obviously have coffee addictions over there. What do Australians drink? Are they tea drinkers? I know they drink beer like Canadians, but are they tea drinkers or coffee drinkers down there? Half Australian. Oh, you're a half breed. Oh, geez. Stay away from Tony. I don't think he likes half breeds. Half breed Australians. You're kind of like my dog. Oh, you're in the UK. Okay, so you're not up late. Not up late. That's good. UK. Never been to the UK. Must be in lots of neat Roman, artifacts there. That's what I think about, England. I think about going to the source of the Thames. I've watched YouTube videos on that, how it just starts literally from a field. And there's a bit of controversy about where the Thames actually starts. I would love to do that. And same with like the canal systems there. I'd love to do that. Lots of old history there. It's pretty cool, but never been. Maybe one day I'll go. Maybe. Well, Canada's pretty huge, and there's a lot to see here. Anyways, I think we're kind of reaching the end here. It's been an hour and 45 minutes. I kind of put it out. Oh, what do we got? Tony's got a response. Ty, all Australians are half breeds of some sort or another. I guess we all are in this day and age, in this global community we live in. Right? Yes, we all kind of are. Is what it is. What does Bud got to say? Bud, I love the name. I love saying Bud. What's up, Bud? Are there any good internal critiques of the Austrian view to push it more towards what you're saying, or is it too far removed from modern work to be relevant? Is he asking somebody else or asking me? Are there any good internal critiques of the Austrian view to push it? So I don't know if you're talking to me. I want to just put it out there. I love heterodox economics and I love Austrian economics. I like reading Austrian economics now. It was the last frontier for me. So I don't got anything. I disagree with a lot of its theories. I disagree with a lot of post-Keynesian stuff. I disagree with a lot of MMT stuff. I sure as hell disagree with a lot of neoclassical stuff, like a lot. I disagree with things out of New Keynesianism, right? But each one, I'm a student of the game. I love it all. So I don't have a lot of critiques for Austrian economics other than it's a little bit anti-empirical at times for my liking, right? Because I'm very data driven, the firm I work for and the modeling I do, right? It's very much data driven. But that said, and that put aside, I love that the good Austrians out there think outside the box. Everybody's got to do that, especially in economics. For me, the economics is the wild, wild west. Right? It's not like physics. Like in physics, you've got hardened things. Tony, correct me. I know you're an engineer, but we've got quantum mechanics and we've got the general theory. If we get into that sort of physics, right? And there's been that push to unify them, but they're essentially what they are, and it's flushed out, and there's not a lot of room to get into physics. But I would say for economics, if you wanted to think outside the box and be one of those revolutionaries that are written about in 100 years, like John Maynard Keynes is written about, or Mises is written about, or Milton Friedman's written about, or any of the other, even Marx. If you hate Marx, right? He's quite famous. Adam Smith, like the father of economics, if you want to call him that, right? There's room in this day and age, if you think outside the box, to be one of those people, right? So that's kind of my long-winded answer, Bud. Well, thank you, and good night, everyone. Graham Turner, signing off. I love talking into like a radio announcer. Today on 99.3 FM, we've got classic rock from Led Zeppelin, Black Sabbath, and a little bit of Christina Aguilera. What? 99.3 The Fox. Anyways, that's about it. 2 days. So Tuesday, I'll be back. I'll be doing a react video on the $37 trillion of federal government debt in the U.S., what its implications are. The person doing the video, you probably could guess I'm probably going to have some critiques of what he's saying. It should be fun. Let's try to shorten up the video this week. The one I did last week, Ray Dalio, check that out on my YouTube channel. It was 40 minutes long, so I tried to find a shorter video, right? And gives me more time to yap and less time listening to somebody else yap. What are your disagreements about MMT? Oh, I've walked into the hornet's nest now. Bzz, bzz, bzz. What are my disagreements about MMT? Now, remember, I love all economics, including MMT, including Austrian economics. But there are things I disagree with. And so with MMT, I disagree that job buffers and job guarantees are actually applicable in the political realm that we have. And hence, why, if it's not applicable, should you push it as a policy option when it's not going to happen? So, those aspects of MMT, I don't agree with the chartalist view that government fees and taxes are the ultimate driver of a currency's value. It adds to demand, but there's nothing quantitative you can apply to that other than it adds a demand. You can't even say that it sets a price level because you can't quantify it. So things like that. Fundamentally, let's be clear, Frank. I agree, like with the monetary operations of MMT, 99.9% of it. It's the policy prescriptions by prominent MMTers that I disagree with. I don't think it's politically possible. And even to talk about them causes political division, which just drives people away from MMT as just a description of monetary options. So things like that. Those would be some initial critiques, but I have to stress I'm willing to have an adult conversation about it. It doesn't have to be, everybody throwing darts at each other in that case. Those are some things. But again, I love Austrian economics. I love MMT. I love post-Keynesian economics. I really like heterodox economics because that's where you're thinking outside of the box. Got Joe Polito in the house. Joe, it's good to see you. Glad you could show up, at least for the tail end of the show. But I love heterodox economics. I'll often debate people in the heterodox more than I will a conventional economist. We saw like one of them on my Twitter. I posted him. He was all about the equilibrium model and battling me with his fake identity that he posted at the end that I picked apart. I rarely even bother with them because it's just nonsensical bullshit that they're putting out. But I will debate like Austrians. I will debate the MMT crowd, the post-Keynesian crowd, because I find that's where we're all thinking outside of the box. It can get a little bit testy for sure. But if we all step back and we're all understanding that we're trying to understand each other so we can build our own worldview and maybe take that, if you're in the economics profession, and you're maybe in the private sector like me, you can take that right out into your modeling world and test ideas, right? So that's what it is. That is what it is, Frank. With you on that. I agree with the mechanics, but not the prescriptions, which are morally subjective. Correct. So this is another discussion I had with somebody last week. We have so many economic discussions, right? I think it was Doug posted something, and I'm with Doug, right? I'm into, positive economics, right? How does the economy work? And if we understand how it works, can we forecast with a degree of uncertainty into the future, right? And provide firms, governments, mid-level governments, federal governments, nonprofits, people, retail investors, institutional investors, can we provide them with forecasts that are helpful to create value in the economy, employ people, et cetera, right? That's what interests me. The normative economic stuff I don't care about. I really don't. And it's a bit of I guess I'm kind of on the left, but I'm not really interested in progressive stuff too much. Like, I care about people. I don't want to see my neighbors hurt. I don't want to see my families hurt. I don't want to see my friends get hurt. And I'm progressive in that manner. I don't want to see war. But when it gets to the point where you ought to do this to be a good person, or you get into the woke type of stuff, I don't go into that realm. The same with the other side, right? The extreme right. I don't get into that stuff. I find it appalling the border policy right now down in the States, and I'll leave it at that, right? So I don't get into the normative, what ought to be in economics and what ought not to. I just want to know how structurally the macroeconomy behaves, and can we use that knowledge to project or forecast into the future to help individuals in said economy, i.e., retail investors, institutional investors, households generally, different forms of government, different levels of government, right, et cetera, et cetera. That's my interest. So that's probably when you brought that up, it's probably good that I mentioned it that way. And my disagreements do come from the ought to be's, the normative statements that we often find. Joe, the Prime Minister. Joe's a Canadian like me. The Prime Minister meeting went overtime. You had a meeting with the Prime Minister? What? 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 Sorry, Joe. Joe, do you remember Stone Cold Steve Austin from the late 90s in wrestling? You would understand why I'm going, what? What? You would understand at that point. It would make sense. What else you got to say here, Joe? If you want to save the world from climate change, we need to move to sovereign money systems. MMT is too limited. Oh, whoa! The hornet's nest might come out. What do you mean? What do you mean? We have to move to a sovereign money system. Interesting. And now you piqued my curiosity, Joe. I was going to end this stream in 4 minutes, and now you've piqued my curiosity. Don't do that, Joe. Don't trigger the neurons in my brain to think, how dare you? I'm just kidding. Post a little more about that. Oh, Joe Polito. Joe Polito's got a burner account. He's got 2 accounts. He's got the one with his face, and then he's got the Joe Polito without his face. See? Joe Polito, and then Joe Polito. I'm watching you, Joe. Dr. T, just present your brain. A nice persona. Too much information. Terry. Terry, is that your name? Dr. Terry? I might already know that, but I've forgotten. How many times did you catch COVID, Dr. T? I caught it 3 times. 3 times. Yeah, my experience each time was a little less intensive for me. So my body, there's some sort of immune reaction there. And lucky I don't have any signs of long COVID, but I haven't had COVID in a while. Maybe I have, and it's been so mild that maybe I thought it was cold. I don't know. Glad we're through it though, but that was 4 times. Okay, well, so that really, COVID brought me into finalizing how to make a very large, complex dynamic system and model COVID-19. It was a compartment model. So, you move from one compartment to another. You were a large one, so you're susceptible, exposed, infected. You were infected at home. You were infected in the hospital. You were in the ICU. You were on a ventilator. You recovered. You could die in either of those compartments, and the percent would change. And my thesis was the waves were actually primarily driven by public lockdown policy, not the changing strains. That was my thesis. Anyways, that's a whole nother story. It was fun to model, though. I enjoyed that. But anyways, we're at the top of the hour. It's 2 hours. I hope, people can take away what we discussed here, right? Make up your own damn mind about what Joan Robinson meant. Make up your own damn mind what you think savings and investment is and what drives it causally, right? I was giving you the information, right? Put it out in different ways so you could think about it in different aspects, both from a monetary perspective and a real perspective. Beyond that, it is up to you to work on it, figure it out, right? Don't go, you want to quote somebody like doing the quotes that I do, go ahead, right? But when you're making a statement, Make it your own statement, what you believe in. When you do that, I know myself and many others will have a lot more respect for that statement instead of some recycled statement. Just putting it out there. Make sure you like, subscribe, hit the notification bell, comment, even on the video after. I'm trying to work the algorithm. Last year I spent all year working on X, blew up my account there. So that's great. Now I'm working this year on YouTube. So I want to get it going. So make sure you do those things. It's important to me. I'm not planning on becoming famous on YouTube. I'm not planning on making ad revenue on YouTube, any of that. I just want to get the message out. I want to have these conversations go out to a wider audience. That is important to me. Until then, we will see you Tuesday for a React video. Bye-bye.
You are now relearning economics.